My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to save you some money. My job is to put a day like today into context because it's a bad one. So call me, 1-800-743-CNBC. Tweet me, Jim Cramer. The implosion of our markets continues. And it's so obvious that this is a man-made obliteration. It's probably not over. Today's action, Dow plunged 2,231 points. S&P plummeted 2.97%. NASDAQ only nosedived 5.82%. Remind you that we're in one of three modalities, okay? We could be in for the grips of a quick bear market, a la the COVID 220 model. We could be in for a 2000-style bear market where tech was laid to waste for a very long time, or it might be the big kahuna. That's the one of October of 1987, where the market went down hard for 3 days, Monday, Wednesday, Thursday, Friday, and then it went even harder on a day we call Black Monday, where the market fell 22%. If the president doesn't try to reach out and reward these countries and companies that play by the rules, then the 1987 scenario, the one where we went down 3 days and then down 22% on Monday, has the most cogency. We will not have to wait out too long, will we? We'll know by Monday. Fortunately, we had an excellent set of employment numbers today. At least it makes it less likely a crash will necessarily lead to a recession. But if President Trump stays intransigent and does nothing to ameliorate the damage that I saw these last 2 days, I'm not going to be constructive here. I will contain my anger, but only because I lived through 87, and in the end, I came out okay. I was in cash for the crash. I know what this feels like. Oh, and if Europe moves against our fabulous tech companies next week, then I will be furious. That I promise you, because it should not happen. None of this has to happen. Which brings me to the game plan for next week. First, if the president does nothing and the Europeans create reciprocal tariffs against our tech companies, we have a very good chance. I want to be very methodical and not unemotional. We're very chance it will crash. It could be like Black Monday of 87. I don't see why it shouldn't. But if President Trump realizes it would be best to help our companies, especially the ones that are hung on tariffs, then we could have a rebound. We will soon find out what CEOs can do to deal with tariffs, because Levi Strauss reports on Monday. It manufactures jeans all over the map, from Japan, Mexico, Turkey, other places in Asia. Levi's offered some weaker guidance last quarter, and it got hammered. Apparel's been a mixed bag, people. The last company that spoke in the space, we just did a piece on it. PVH said very good things. Calvin Klein, Tommy Hilfiger are doing well. Maybe Levi Strauss made the quarter, too. A few weeks ago, Walgreens decided to sell out to a private equity firm, a storied name. See you later. The company that's buying them, Sycamore. I think this was a great deal for Walgreens because otherwise I fear it would go the way of the zombie firm that is Rite Aid. But let's see if things have gotten better or if maybe there's some real buyer's remorse. Nothing would shock me. Tuesday night, we hear from Cal-Maine. Now, normally I wouldn't care at all about some egg company, but eggs were the key driver of the most serious inflation experienced in ages, so maybe they can explain what the heck happened. Wednesday, Delta reports. I expect an awful number. They already told us things aren't so great. But has business stayed weak from their last report, or maybe even weaker? I worry that the travel bull market is completely done, especially if we're going to go into recession. After the close, we get results from one of the most controversial companies in America, and that's Constellation Brands, STZ. This electrical company, the maker of Modelo and Corona, simply can't be sure yet what the tariff impact is. If it's imported Mexican beer, will it be tariffed at what rate? Will it not be tariffed? It will be the old tariff that we had, which was none. Tough to tell. As someone who's trying to figure out the tariff for Phosphoro, our Mexican mezcal band that can't be made here, we're trying to figure, is it 25? Is it 10? Maybe it's exempt. I have no idea how will Constellation approach things, though. I want to know. This company already has enough problems with the existential threats of anti-craving GLP-1 drugs, including cravings for beer, and the health and wellness trends that discourage alcohol. The last thing it needs is tariffs. This stock plagued my charitable trust until we finally jettisoned it at a big loss, and I think it's become totally problematic, like all the liquor companies here. I suspect Constellation's also been hurt by Trump's immigration crackdown because so much of their customer base is Hispanic. Hard to see what the company can do about any of this. It's a once great story. There are so many things to keep in mind when the White House starts to raise tariffs. Right now, I'm most worried about inflation, which is something that'll be, let's say, something we'll be thinking about a lot when we have the CPI report. This is what really matters. See, because This is where we are not going to be able to cut rates if these numbers start being bad. Inflation became very sticky, and it was no longer going the Fed's way even before the tariffs. Now it's going to go straight up, which is why, well, what always happens with tariffs, except that they're so high that nobody buys anything. Always a possibility. Given the scale of Trump's tariffs, there's no world where they don't raise prices on the consumer, on you. It's never good when the Fed's trying to cut rates and get the economy going. I say the Fed's locked in a box here and can't do nearly as much as they might like because they don't want to spur another round of inflation on their own. Of course, that just increases the likelihood of a recession. And many of these banks are coming out and talking about that we're going to have one. They're looking at the 10-year below 4%, and they're saying, oh, it must be a recession. Did anyone in the White House think that these things could happen? Now, anyway, we just profiled a company called CarMax the other night. It reports Thursday. And when new cars get tariffed, used cars become a lot cheaper by comparison, which should spur sales for CarMax. The stock's no longer cheap, selling at 23 times this year's earnings. But I think this might be a real investment, given the fact that the president seems unwilling to back down. Then again, if we get a recession, it doesn't really matter. You don't want to own anything connected to autos in a recession. Friday, well, here we go. Earnings season, and it's real big. It officially kicks off with the big-time financials reporting. These stocks have been crushed because Wall Street now expects a nasty downturn in the economy. The declines here are staggering. Take J.P. Morgan. It's one of the best banks in the world, but people are incredibly skittish about paying up for a bank ahead of an unexpectedly horrendous capital market. So instead of paying 14 times earnings, they're now paying just 11 times earnings. And the stocks declined from 280 to 210. That's down 17 points today alone, by the way. That's an unfathomable journey down from the mid-February high, where we believed in a revival of financial activity spurred by aggressively pro-business president. Morgan Stanley got the CoreWeave deal done, and thank heavens, done at a better price than I thought could be expected, given how the press was hectoring the deal so much. Otherwise, there's not all that much to celebrate at Morgan Stanley, though. I keep hoping that something will fall in the capital markets, but if anything, it has just gotten worse because of the tariff issues. Charitable Trust owns several financials, including BlackRock and Wells Fargo, both of which are just getting clobbered beyond all recognition. I don't think that they should be, but so what? Wells is a national bank that was doing incredibly well until it ran into a macro buzzsaw that was the president. I think it's now outrageously cheap. But what the heck is CEO Charlie Scharf supposed to say on his call when he's asked about the future? He has no choice but to be cautious and circumspect, and the stock can't rally in that kind of environment. The best for last, BlackRock. I think that CEO Larry Fink, perhaps the most thoughtful exec in the group, will give us a much-needed gut check about what happened here, where we had a well-oiled economy all set for a pro-business president to take it to the moon, and instead what we've gotten is a journey to the center of the earth. It's an incredible conundrum, and I really hope Fink will take a moment to tell us what he sees. We need to know. Look, this was a terrible day on top of a terrible week. It feels like one of those pre-crash moments in October of '87, which I lived through and traded. The eve of Black Monday. That Friday was terrible. I remember going home thinking, I can't believe how much money I lost, but I sold everything, and then Monday you come in and boom. Our only real hope is that the president comes up with something that can turn this bear into a bull, and he can do it, even as he seems unwilling to scale back the tariffs. All he has to do is offer our companies a path to get out of this hell that they did not create and they do not deserve. But the bottom line, that's a very glass half full hope in what feels like a glass totally empty market. Amazingly, a year after the crash of '87, you were up on most stocks. So despair not, because at least I have your back. Scott in Minnesota. Scott.
Well, thank you. Hardworking man, Jim Cramer.
Not hard enough. Not hard enough. Not this week. I should have worked harder. My wife was back in Florida. I should spend some time with her. Shouldn't have.
Well, I tell you what, you've taught all our club members and viewers to, look at all this stuff with calm discipline, or at least to attempt to stay calm.
Thank you. Thank you, Scott. Thank you. And that's what we want, because even in '87, it was fine by '88, and in 2007, it was fine by 2013. But I got you out of that one, but clean. Let's go to work.
Right. Hey, with your help, I know we can get some great stocks at a discount.
Yes, we can.
Instead of selling in panic.
Good.
I tell you what, as a member of the club since day one, I've been watching this stock for a long time. Is now a time, or when would be a good place to begin a position in Caterpillar?
Okay, this is a great question because Cat has given up almost everything. It's given up everything. And Jim Appleby is a terrific guy. Here's what you have to do. You have to wait till he reports. You can't jump the gun on this one. Even let's say we crash on Monday, we're down 22%. The stock will probably be at 198. I bought it on the day of a crash in 87. It's funny you mention it. But we won't know exactly whether he's buying back stock or he's pulling in his horns until he reports. He's too straight a guy not to listen to. We can't pull the trigger until he says something. And thank you for your kindness, for your words of encouragement for me. I feel like I didn't work hard enough this week because I didn't say get out now, but that's not what I can do anymore. Anyway, just remember, even a year after Black Monday, we were up on most stocks, so do not panic. I have your back, Cramerica. Someone has to. Man, tonight, after another day deep in the red, I'm helping Cramerica make sense of this part. Hey, first, luxury RH plummeted on the news of the tariffs. You hear that today about the other day? I got the CEO, get a better read on the company's global business and the tariffs. Then I want to look at the possible opportunities for success amid the sell-off. And that's why I'm seeing I got one for you. I got an auto parts company that I think you can buy right into this miserable tape. Plus, could a salad chain be a sweet spot in this tape? Because remember, domestic, no tariffs, people still going to eat. I think. David Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Wednesday night, as President Trump rolled out his meat axe tariffs, the luxury home goods retailer RH was holding his conference call after reporting a little bit weaker than expected quarter. Stock was rolling over, but once these not so reciprocal tariffs were announced, the darn thing got crushed because most of their manufacturing is overseas, especially in countries that now have shockingly high tariffs, like think Vietnam, China, Indonesia, India, even Europe. It was so ugly that the CEO made, well, let's say he spoke freely. In the end, RH plummeted 40% yesterday, plus a bit more today. Now the stock's down roughly 63% year to date. So what happens next? RH is trading like this is an existential crisis for their business. Is that really a concern? It's a great growth company. Or are people simply panicking? Let's talk it over with Gary Friedman. He's the chairman and CEO of RH, who should be commended for coming on and talking with us during a very tough time for his company and many others in his industry. Although I think he's really in an industry of one, and he is in the arena right now. Mr. Friedman, welcome back to Mad Money.
Thanks, Jim.
All right, so Gary, I obviously want to start with take us through Wednesday night and what happened, because it was obviously very different than a typical earnings report that you've given, and it was happening in real time. I'd just like to know what you were thinking.
Well, you had to be able to think on the spot, right? I think the tariffs that were announced, while somewhat anticipated, were somewhat shocking at the levels that they were communicated. And what we tried to do, at least what I tried to do, is address the situation as we saw it. And look, if you just motor up and say, our company's been operating with 25% tariffs out of China since the last Trump administration. So tariffs are not a new thing. And we've successfully resourced the majority of China sourcing to Vietnam at significantly better than pre-tariff landed cost pricing. So we feel like we're in pretty good shape. And additionally, we communicated that we've resourced a meaningful amount of China production to our own factory in North Carolina. So, start up there. That's number one. Number two, we communicated, and I tried to be direct and honest with our point of view on this, is that, we believe that President Trump is using these significant tariffs to really as a negotiating tool to accelerate the negotiations with the intent to improve balanced trade conditions around the world. I think that's the intent of the administration. And quite frankly, I can't really criticize them for that. We're kind of happy it's not death by 1,000 cuts, that, we're not starting with 10% or 20% tariffs and, 3 or 4 months negotiation goes by, it gets raised again,
Right.
gets raised again. It becomes an elongated situation. In fact, if you think what's already happened, I don't know if you're aware, if you saw President Trump's tweet on Truth Social today.
Sure.
But he just said he had a very productive call with To Lam, the General Secretary of the Communist Party of Vietnam, who told the president that Vietnam wants to cut their tariffs to zero and believe they can make an agreement to do that. Now, do we believe tariffs will go to zero? They may not. But they may not be 46%.
But Gary, I've worked with you since 2018. You have diligently moved. I mean, you were 46% China, then 41% China, then 38, then 35, then 34, then 29, then 22, all the way building up with Vietnam. And I was so proud of you. You listened to what the president wanted, and you understood that Vietnam was a better place in terms of being a better friend. You did everything you're supposed to do, and then the tariff is it's monstrously high on Vietnam.
It is, but you've got to even if it's at 46, you got to keep it in perspective. Okay, we resourced product to Vietnam at a better than China pre-tariff pricing.
Okay.
So even if you put 46% on top of it, is it more difficult than 25 out of China? It is, but you're starting at a better price. At a better place, right? So, net to us, it looks like it's about another 20% increase, which is manageable, which can be absorbed through, some negotiations with our manufacturing partners, with some, higher pricing to the consumer, and somewhat minimal impact to our margin structure. Because remember, we sell relatively high-priced goods compared to anybody else in the market. So you've got, with furniture, you have a big landing factor on the goods because you have a big freight cost getting product to America. So at higher prices, even if they are tariffed, you've got leverage on the freight cost. So freight cost as a percentage goes down, supply chain cost as a percentage goes down. And I think what the market doesn't understand with tariffs is what does it look like through the entire economic model of a company like ours?
Okay.
We've been able to negotiate, to navigate the last tariffs. We can navigate these tariffs even if they're 46%. Is it more difficult? It's more difficult. Is it going to change the outcome of the company? We don't believe so.
But at the same time,
but we also don't believe. We don't believe they're going to be 46%.
True. I know, and I sure hope they're not. But at the same time, you did talk a lot during the call about the repurchasing you did, about what it did to the debt load and what it did to your cash position. I've seen you come through everything. In 2008, I saw everybody else get crushed. You came out and you were stronger. Can it be like that again, or are you playing it a little bit closer than you like, given your negative free cash flow?
We're perfectly comfortable. Look, Jim, I'm the biggest shareholder, single biggest shareholder in the company, and have 99% of my net worth in RH. So I'm not going to put my own net worth at great risk. Do we have meaningful debt? I addressed that on the call. Yes, we do, and it's in my letter. Do we also have, tremendous business momentum right now? Yes, we're just up 18% on the 13 versus 13-week basis in the fourth quarter. We're 15 to 25 points ahead of anybody else in our industry. So we have tremendous business momentum, and we have significant assets. Okay, we own roughly, estimated $500 million in real estate assets that we can monetize as market conditions warrant when we want to. We also have brought in incremental inventory at basically to de-risk our merchandising transformation and de-risk the potential for tariffs. So we've got, call it $200 to $300 million at cost of additional inventory we're carrying today. Now, that's not just you got to think about cost at retail. You're talking about $600 to $900 million that we can turn into cash, and we have less risk in a tariff transition, I believe, than any other retail company of our kind on the planet today. Some people think that extra inventory means we have more risk. It's exactly the opposite. we've already paid for that inventory. That inventory can be turned into cash, and it also de-risks. It puts us in a position to not have to order immediately while tariffs might be 46% or whatever country we're coming out of. It allows us to say, hey, we've got enough inventory to kind of play this game the way we want to play this game.
But I
don't believe anybody else does.
I know, but you taught me also that the stock market matters. That if the stock market gets killed, there'll be some wealthy people who will pull back. Well, we got killed.
They might pull back, Jim, but they also might run to buy furniture if they believe it's going to be more expensive. Okay,
That's
so
true.
I would tell you that the last couple of days looks like people are probably running to buy furniture, running to buy cars, and so on and so forth. So it's going to move around a lot. I'd say today we're very comfortable with where we are. We just, in fact, at this moment, I believe we're putting out a press release to kind of give an update on the reciprocal tariffs and our view, to kind of reinforce some of the things and add more color. But, our business to date this quarter, in the RH brand is up 20%. Our whole competitive field is guiding +2, -2, up 5. So, think about a company of our size, with demand running up 20%. Now,
well, is your release? I mean, we're not missing anything from your release. I mean, you're not burying it. There's not some big story in the release that's going to come out. And I'm going to say, why didn't I ask Gary about that? I thought he liked me.
I'm telling you about it right now. I didn't want to take any risk. I'm only telling you. But look, because we went on moments after the Trump tariffs came on, we're kind of the poster child for tariffs at this moment.
Yes.
And because we have cleaner disclosures, I believe, than anybody else in the country. We disclose exactly where we're sourcing from, where many people are much more opaque, saying, oh, we're sourcing the highest percentages this country or all of Asia. We're very transparent. And so I think our transparency is hurting us a bit. Other people that are more opaque maybe aren't getting hurt as much. People can see we have a meaningful amount of debt based on the fact we bought back $2.2 billion of our stock. That's, understand some of the noise.
Okay.
But the key thing is don't let the noise, dilute the truth and the true signal here.
But
this is a company that is growing massively faster than anybody else, that is well positioned to move through this tariff situation, however it plays out. And some of the debt we have is because we bought $200 to $300 million more inventory in anticipation of this. So, look, I think I decided to come on today because I thought, look, somebody's got to go out there and fight for our shareholders because the press isn't always so kind if you're the first person out talking about it. In a conference call like we did. So, I'm just trying to be clear to everybody.
Well, you got rates going your way. Interest rates are coming down, right? You didn't even mention interest rates are coming down, which is something. Now, your people are richer than worrying about a 6% versus 7%. But that goes your way in terms of the possibility of the worst housing market in 50 years. Maybe we're going to catch a break with mortgages and we get some transactions. Maybe that happens.
That might happen. But honestly, we're somewhat indifferent. We're outperforming everybody in the worst housing market by a meaningful amount. So I just say, just however the cards play out, I'd say bet against us at your own risk.
But I would like to see. I don't want to bet against President Trump. Fine. Maybe President Trump listens to the interview and realizes maybe I should do something this weekend.
Yeah. Well, look, I think like I said, I actually think, the whole world's a little shaky about this. We haven't had a leader who's ever moved at this speed with this clarity and who has negotiated at this level. I tell people, this is, somewhat like the negotiations during the Cuban Missile Crisis. This is kind of President Kennedy, communicating directly to Khrushchev, but we've got a president that's communicating to the whole world, right? And he's got leverage, and he's using leverage. And at the end of the day, it's all going to be really good for a country that has a broken balance sheet, and needs to balance budgets, needs to fix our balance sheet. I think our economy could come out booming post this period. So the key is be able to navigate through this.
Well, look, you're a gent to come on. You've been the best. You've been with me the whole way since the show started. And yes, I am pulling and rooting for you, but maybe I don't have to because the numbers are good. Thank you, Gary Friedman, who's the chairman and CEO of RH. It's great to see you.
Great. Thank you, Jim.
And Khrushchev did blink, didn't he, in the end? He blinked big.
He did blink.
That was the high water mark of that whole darn operation. Everybody's back after the break. We're now 2 days into this insane new era where we need to come to terms with sky-high tariffs on essentially all imported goods starting next week, and most industries as well. And I got to tell you, the market is clearly not ready for it. We all see that. So what do? We got to look for new ideas. Some stocks that can work in a truly terrible environment because we're going to try to make money in any market. Last night, I kicked off the show with a list of sectors that should work in a government-mandated slowdown in healthcare, utilities, phone companies, off-price retailers, certain financial technology plays with no credit risk. Those were down today. What a great opportunity. That's the way I look at things. I also think the used car dealers win in a world where new cars are becoming a lot more expensive. It's a good list to come back to, and it's not Mag 7, okay? I can say those names. If you want to hear the names Mag 7, I can always rattle them off in my head. But I like to talk about new opportunities. I like to talk about money. But we can take that just one step further. Some people won't even be able to afford a used car if we're headed for a serious recession, will they? You know what I mean. Remember, these tariffs will make all sorts of imported stuff more expensive, potentially reigniting inflation. And the Federal Reserve can't bail us out when rate cuts. They can't do rate cuts when inflation's surging. That's just not in the textbook. So if you can't afford a new car or a used car, what the heck are you supposed to do? Simple. You keep driving your old car, even if you need to spend a lot more on maintenance to keep it running. And that's why tonight I want to talk about the auto parts retailers, O'Reilly Automotive and AutoZone. No, it's not Microsoft, okay? No, it's not NVIDIA. These make you money. These are the two big players in the space. Don't worry, the others will make you money, too. I'll tell you when they will. Now, there used to be a third major player, Advance Auto Parts, but they've been lost to the wilderness for years and show no signs of making a comeback. I'm going to leave that one out. Honestly, while I think the tariffs on new cars will help these companies by forcing people to stick with their older vehicles, you don't need a special occasion to recommend O'Reilly and AutoZone. They have some of the best track records of outperformance that you'll ever find in any market. Pick anytime. 1 year, 3 year, 5 year, 10, 15, 20. Over whatever period you choose, these two stocks have drastically outperformed the S&P 500. And it's not fish or fan with these two. Both O'Reilly and AutoZone have some of the most beautiful long-term stock charts you'll ever see. It's just steady upslopes for basically the past 20 years with very few interruptions along the way. Full disclosure, the last time these auto parts chains reported, their numbers were technically mixed, but they mostly look pretty good to me. First, O'Reilly Automotive reported in early February and delivered a big same-store sales beat with a smaller overall total revenue beat. I care about same-stores more than I care about total. Their earnings came in a little light, but that was really entirely because of a self-insurance reserve adjustment that was very hard to understand. O'Reilly's a little unique in that, unlike the vast majority of publicly traded companies, they don't report adjusted earnings, just the GAAP numbers, which is the only reason this looked like an earnings miss. Had it been adjusted, you would have said, wow. However, O'Reilly's full-year forecast was clearly below expectations, with inline same-store sales and weaker than expected earnings. Now, that doesn't scare me. Why? Because these guys always issue lowball guidance, which is one of the reasons why the stock barely got hit at the time. In fact, even with the market-wide meltdown, including the horrific last 2 days, this stock's still up double digits for the year. How many other stocks do you have that are like that? As for AutoZone, long my favorite, they reported early last month. AutoZone also had strong same-store sales with an earnings miss. The problem, unlike O'Reilly, AutoZone has some international exposure with hundreds of stores in Mexico and a little over 100 more in Brazil. Now, that international business hammered them this past quarter, largely because of currency fluctuations. But the core business in North America, very solid. Now, AutoZone doesn't give formal guidance, but management sounds very confident about its outlook going forward, with CEO Phil Danielle saying, and I'm going to quote him, We are excited about our momentum heading into the back half of the fiscal year, and we are all well prepared for our spring and summer selling season, end quote. So the stock got a nice 2% pop on the news, and it kept running until today when the whole market went into a tailspin. But AutoZone is still up 5% since the quarter and 14% for the year. Now, some of our sharp viewers may say, wait a second, isn't Trump placing tariffs on auto parts too? And aren't auto parts made in China? Oh, yeah, there's a 25% tariff on imported auto parts. That's the same rate as imported cars, although the auto parts tariffs don't go into effect until May 3rd. Still, even with tariffs on auto parts, I like O'Reilly and AutoZone because automobiles and auto parts are two very different markets. Buying a new car is usually a discretionary purchase. But buying used car auto parts or new car auto parts? Wait a second. That's a necessity. People will be willing to pay up because the alternative is your car won't start. Consumers will eat the 25% price increase on auto parts because they have no choice. They need them to have their car work. Let me make one more point about these two auto parts changes, and this is the most important one. For years, O'Reilly and AutoZone have been such huge winners because these two companies are gigantic repurchasers of their own stock. For O'Reilly, its share count peaked in 2011. Since then, they've shrunk the number of shares by nearly 60%. AutoZone's been doing this for even longer. It's one of the reasons why I've recommended the stock since the show started. They started getting aggressive with buybacks in 1998. Since then, their share count has shrunk by a remarkable 90%. That's right, 9-0. They had 152 million shares in 1998. They now has less than 17 million shares. In the past 20 years alone, AutoZone's shares count is down almost 80%. It's like these companies are on a kind of, I always say, slowly taking themselves private. Hey, by the way, both the big auto parts chains have buyback authorizations in place right now. So if they get hit because of this crazy market, they'll probably be in there buying. O'Reilly has roughly $2.3 billion left in its authorization. AutoZone had $1.3 billion. And that's why I love these companies. Even if their stocks end up getting hit at any given time, you can count on them to be buying their own shares right there alongside you. So here's the bottom line on these two terrific stories on a day when everyone's worried about the Mag 7 and all the rest of the nonsense. We're looking for new groups that work in this horrifying new environment. It's slim pickings out there, I can tell you that. But there's still some good opportunities that you can make money in any markets with. And those include O'Reilly Automotive and AutoZone, which should benefit as consumers who can't afford new cars anymore are forced to extend the life of their old ones. Like I said at the top of every show, there's always a bull market somewhere, and I keep trying to find it just for you. Right now, I'm committed to trying to find the bull market opportunities wherever they are in this red tape because we can make money in any market, you and me. One place I think you could look is the auto parts retailers. They're growth stories, and they buy back a lot of stock. I'll take that any day of the week. Much more Mad Money ahead, including my look at the state of the consumer with Sweet Green's top brass. We're going to find out whether people are still going out of it. Of course they are. Then what should be the game plan in the Oval Office for the market's massive move lower that they've caused? I'm telling you where I stand on the tariff talk from Washington. And of course, all your calls rapid fire. Tonight's just a little lighting one. We will find ways to make money. Stay with Cramer. Look, I know the market's a nightmare, okay? So do you. But there are a couple companies that have minimal tariff exposure and could do fine in recession. Stocks are selling off just like everything else. That seems wrong to me. Take Sweet Green, health-conscious, salad-oriented chain with about 250 locations across the U.S. Oh, look, the stock's been hammered. It's part of the market-wide sell-off. It's down another 7% today. This thing was trading at $45 at its high in November. It's now at $20 and change. Now, this company's not sitting on its laurels. It is doing things to expand, and it's not impacted by political issues or the deficit or anything in Washington other than the founders went to Georgetown. They're on the front line of the American consumer, and we got to find out how the front line's doing. So let's take a closer look with Jonathan Neiman. He's the co-founder and CEO of Sweet Green. Find out. Mr. Neiman, welcome back to Mad Money.
Always great to be with you.
Thank you, John. Now, one of the things I've been thinking about is that there are two kinds of companies in this country. There's the companies that cater to domestic consumers and are doing a pretty good job. And then there's the ones that moved overseas, and those are the ones we have to worry about. When I look at Sweet Green, I think it's a company that if it does a new loyalty program, if it has a new French fry, if it does something exciting like Infinite Kitchen, it still matters. And we shouldn't just be thinking, oh, woe is me, China. Oh, woe is me, Vietnam. We're doing fine. Is that a reasonable assumption in your mind about what Sweet Green's up to?
I think that's largely right, Jim. We're very focused on just playing our game, focusing on the fundamentals and taking care of our customers. So we started this business almost 18 years ago with the simple vision of redefining fast food and just serving healthy, delicious food to communities. And we're going to ride the waves. There's a lot of turmoil in the markets right now. There's a lot of things going on, but luckily, our business is here in the U.S., all 250 company-owned locations. And again, just focused on delighting our guests by serving really, really delicious food and continuing to innovate with a number of the things you talked about, like our new Ripple Fries that came out a couple of weeks ago, our loyalty program that launched just this week, and our rollout of the Infinite Kitchens.
So, I mean, this totally fits my thesis, which is that people who want to give up on the stock market don't realize that it's a market of stocks. And there's a company like Sweetgreen that has a game plan. And that game plan is not necessarily impacted by what is happening every minute in the market. But it could be impacted by huge inflation in terms of your raw costs. It doesn't seem like inflation is eating that much into what you do.
Listen, it's a very fluid situation. Luckily, we have a mostly domestic supply chain. But of course, these sorts of moves can impact prices. They can impact consumers. So we're watching things very, very carefully. We're trying to be super disciplined. But again, it just forces us to sharpen our focus. When the waters get a little rough, all that we can do is just be more disciplined and execute better. And that's all we can do right now. So focus on providing the best value for our customers on the food we serve, continue to innovate, just put out delicious food that is healthy, open great new restaurants, and manage our costs as best we can. And so, I think we're better situated than most, but it's as we're all seeing, it's a very, very fluid situation.
Well, at the same time, it's not like you're just sitting back and saying, let's hope things go okay. You put in a loyalty program. I've always felt that companies that don't have loyalty programs that are in your industry just haven't thought through the new kind of value-conscious consumer. And it's everyday value. It isn't like they wake up today and say, oh, man, the market's really bad. I'm suddenly caring about value. They're going to look at your place and say, look, he's got a certain deal. Sweetgreen's got a deal. I don't know. Is it as good as another deal? And they think like that. That's the new consumer. How did you configure your loyalty program?
So our loyalty program was thought about of how do we create a program that can provide very simple construct rewards for everyone. $1 gets you 10 points, and you have different point tiers to earn different things, but also layer on some special things around community and recognizing our best customers. So there's a lot of surprise and delight built in, including a special tier we call the GOAT tier, the greenest of all time. So our best customers will be put into this GOAT tier. And then there's the personalized one-to-one marketing piece. So what it allows us to do is really kind of leverage our CRM and offer rewards to customers on an individual basis, get to know them, know what their eating behaviors are, what their likes and dislikes are, and market to them, directly in a one-to-one way. And we think, given the digital penetration of the brand, we're looking at over 50% of our business is digitally connected. It gives us a huge opportunity to leverage that data to better market to our consumers. Well, the beauty of the Sweetgreen model is how habitual it is. So we just want to play on that habituation because you feel good when you eat it and you just want to eat more.
Well, you know what? I'm glad you came on because I wanted to hear something other than the fact that the president did this or that and companies had to do this or that, because I really think it's vital for people to realize some companies have a little more control over their destiny than others. And that, I think, is what you have. Jonathan Neman is the co-founder and CEO of Sweetgreen. Delight to speak to you. It's delight to have someone who's got something good to say on a day like today. Thank you so much for coming on.
Thank you. I got to say, people got to eat, right?
Oh, they always do. Isn't that terrific? Everybody's back after the break. Thank you.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next.
It is time. It's time for the lightning round. Because that's right. Balls over the scene. Let's talk to you about my social tip. And then the lightning round is over. Are you ready to keep that? The lightning round. Let's start with Bruno in Massachusetts. Bruno.
Jim, I'd like your take on Archer Aviation, which recently
a little too speculative. We're not going to recommend stocks, sir. We're losing money in this kind of environment. Let's go to Jerry in New Jersey. Jerry.
Hey, Jim, how you doing?
I'm doing good. How are you?
I go out and I buy an American ship company, GFS. What's going on?
Yeah, well, the problem is they make small. They do not make the latest and greatest, and that's the problem. Taiwan Semi does, and no one wants to touch that stock either, so don't feel bad. Let's go to Roger in Arkansas. Roger.
Thank you for everything you do for us, Jim.
Thank you, Roger.
So buy, sell, or hold, and what price should I buy ORI at?
Right here, ORI is a winner. It's a terrific situation. Let me throw in Chubb like that, too. How about Kevin in New York? Kevin.
Hey, Cramer. I am here with my 13-year-old son, Mason.
Excellent.
Who has his own portfolio, and he also has a Roth that he contributes to.
Okay.
Hi, Jim.
Nathan, how you been, buddy?
So, Jim, a couple of months back, you said that you might like this stock if it came down enough to have a 7% yield. Well, right now it's at almost 9%. So what do you think of Dow Chemical? Yes or
9%.
no?
See, I looked at that today. There were a bunch of guys who cut the price targets. I said to myself, wow, 9%, that is no longer a go. When something's that outsized a yield, I have to take a pass because it means that there's something awry. And thank you, Nathan, too, for listening up. Let's go to Henry in Colorado. Henry.
Hey, Jim, I'd like to get your thoughts on the impact that you think that these impending tariffs will have on Danaher, DHR.
Danaher's a stock that I wish I did not own for my travel trust. I keep hoping for the best, which would mean that Mr. Blair would be able to spend more time with his family because he is the CEO. And right now, I think that he's not doing an appropriate job. I am concerned that next I'll wake up on Monday and find that the Chinese have kicked him out. So let's just say that there's a way to be able to manage your business. I saw this with Estee Lauder, same thing. Great company, didn't do it right. Time to step up. Danaher board. Let's see a pulse, okay? I'd like to speak to Logan in Wisconsin. Logan.
Booyah, Jim.
Booyah.
Looking for your thoughts on Robinhood stock, given the
Okay, I like Robinhood very much, but the problem is that when it had this big spike when things looked like we're going to have a president that was a little more pro-markets, I would own the stock. I would not buy it right here. I think the stock has another 15 to 20% downside before we really find exactly where it can be bottoming. Raymond in Massachusetts. Raymond.
Yes, good afternoon, Mr. Cramer, and thank you for taking my call.
Thank you for calling.
Okay. You said a while ago to keep an eye on LyondellBasell, ticker LYB, and I have been. And I'm wondering if, one, if you see the company is stable and its dividend is stable, and would you recommend accumulating some shares?
Okay, here's the problem.
Point?
This, and I'm going to do it too for this and Dow. They need China to get stronger. They need worldwide growth, and we've got China getting weaker. We've got worldwide weakness, and that's unfortunately makes it so we can't take some down. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
There's a path, a way out of this box, as I said at the top of the show. The president is fixated on the long term when he talks about trillions of dollars that the tariffs will bring in. He says the tariffs will allow us to fund both tax cuts and a lower budget deficit. Putting aside whether that is going to be true or not, I don't think we have the full luxury right now of focusing on the potential long-term benefits because the short term is a horror show. These tariffs are incoherent and enormous and not at all reciprocal, which is why they triggered a needless firestorm. It's almost like President Trump wanted to be as dramatic as possible. He's producing a TV show rather than running the country. Ratings supposed to be through the roof. But in the stock market, we don't want drama. We don't want a TV show. We want a president who can get things done besides rolling over law firms, which he certainly could do, and ideally not throw the economy in recession in order to save it. The ham-handed way the president ordered these tariffs, which, by the way, are larger than the Smoot-Hawley tariffs that arguably did help cause the Great Depression, was bonkers. Here's what I care about. I don't want there to be a crash in the stock market, not on Monday, not Tuesday, not ever. I don't think the president wants one either, but he doesn't seem to be worried about it. He should be worried because we're a nation of people who are trying to save for retirement, and the stock market is the best way. Americans should not have their savings sacrificed on the altar of long-term benefits, especially when he could have lowered the boom on our trading partners without causing all this disruption. And remember, I am a hardliner on trade, harder than pretty much everyone. I don't like globalists. If the White House had rolled out genuinely reciprocal tariffs as opposed to whatever the heck he did, then our government could have started the process of rejiggering the world order. The president called it an operation. The patient will be well and we'll have trillions. I disagree. I think the patient's now touch and go and is in real trouble because of the ill-considered surgery. Sure, the Fed has the ability to lower rates. That's great. Yes, treasuries are going in the right direction. We could see great, maybe housing recover, great unemployment. Oil's going down too. But with the exception of the employment number, these are all signs of an impending recession. Consider everything that's going wrong here. First, the stock market isn't working right at all. Look at the stock of private equity companies. They're being killed because they own a lot of highly levered businesses that they were planning to bring public under President Trump. People were worried that those IPOs won't happen anymore. The market's so ugly. If we want to get out of this mess, we need some signs that the president understands the need for a functioning market. We just saw today Klarna, Chime, and StubHub pause their IPOs. Very bad. Second, Trump needs to recognize that we may have strong employment now, but that won't be the case in the future, which is what matters. He has to focus on what can happen in the shorter term, too, not just the longer term. It's part of the job. We don't elect our leaders for just long term in this country. If you can't deliver in the short term, too, your party's toast. Third, he needs to be more constructive toward the countries that genuinely want to do deals, like Israel and Vietnam. Why not? In Trump's first term, the administration was encouraging manufacturers to move from China to Vietnam, as you heard with RH tonight. Those companies need our help now. It's so ironic. The president's always talking about the working people who lost their jobs in the order of free trade. And that is true. And that's what makes me not a globalist. But how about the workers in current jobs who will be laid off because of the crushing tariffs? Why is there no recognition of them? I'm not a free trader, but even unfair trade is better than no trade. The president needs to make a commitment this weekend to help companies that want to avoid the tariffs. He needs to call world leaders and say that they can roll back some of the tariffs that he's putting on them, but they got to play ball. Mr. President, don't cause a crash. It will be your legacy, and it can easily be avoided. Jay, I got an idea. Just bring back the art of the deal. I like to say there's always a bull market somewhere, and I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer, and I will see you on Monday.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.